Turnaround Tuesday. Will it stick? Live from New York City this morning. Good morning, good morning. For our audience worldwide, there's the bounce. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, a new low for 22.
The past 2 weeks it's been ugly.
There's been no place to hide.
Stocks keep going down. It's painful and horrible.
Cash is king.
Whether it's fixed income, equities, commodities, currencies.
The unfortunate reality is everywhere is a pain trader.
But are we at the lows? It's difficult to say.
This is a hard market.
The rates seem to be driving the bus.
You've got to take the Fed at its face value.
This very rapid shift in financial conditions.
If anything, we're looking for opportunities in this market.
It's a bit late to be going underweight at an aggregate level.
Use some of the events like we've seen this week to start building more positions in your portfolio.
There's definitely opportunities when things have sold off this hard.
Everybody's trying to read between the lines.
Joining us now is Julie Bill of Kane Anderson Rudnick and Aberdeen's Luke Hickmore. Julie, I wanted to come straight to you. A new low for 2022. We closed out those lows just yesterday. A bounce right now on my screen with futures up just a bit on the S&P, up by about 1%. Is it time to nibble? Time to put some of that cash to work?
Well, I mean, I never recommend being fully out or fully into the market. I think keeping a little bit of dry powder is really going to favor certain investors. It's a good time to be upgrading the quality of your portfolio. So if you have any losers that you've just been holding on to, waiting, this is the time to get out, or actually the time to get out was probably a while ago. But suck up the losses and find the proper good businesses that are going to do well in a recession. I think it's really important to have a quality portfolio.
Luke, are you biting yet?
I'm starting to bite on duration, Jonathan. I think US 10-year, US 30-year, both looking attractive. UK still feels like a basket case.
The 30-year in the UK, I can tell you, is up by 26 basis points at 480. Is that a basket case or a monster opportunity?
It's still a basket case. I think the problem is starting to now be LDI accounts are having to meet massive calls for collateral. We're seeing some big selling around that. We've got a massive syndication coming in tomorrow as well. We've got the banks starting to sell gilts very soon, trying to sell corporates today. And from what we're hearing, not doing very well with that. No, I wouldn't go chasing the 30-year UK at all.
Should you chase the front end? In America, the 2-year
Yes.
right now, 425, and most people say yes. And Julie, I wonder, we've repriced terminal rates in an aggressive way that's pushed up the front end of yield curves all around the world. I'm trying to work out whether you think that's something that's going to stay with us for a while. We need to get used to that. We need to be pricing off 4% for a long, long time.
Yeah, I think we have to, right? Because if you look at the persistent drivers of inflation, they're pretty long-term and sticky in nature. So I don't think they're going to be lifted anytime soon. You know, it's been stubbornly high levels of employment. You know, we would expect that demand to soften, but with higher interest rates, but that really hasn't been the case. And so until that happens, I just think this is the new normal, and we have to kind of continue and incorporate that into our forecast.
A lot to keep up to speed with this morning. Futures rolling over just a little bit, still up by 1.1% on the S&P. Yields on a 10-year yesterday closed at the highest level since 2010, coming back in just a bit on a 10-year by 5 basis points to 387. Kaylee Lyons has more. Hey, Kaylee.
Yeah, it's just monster moves we've been seeing in the bond market. True here in the U.S. with the biggest upward move on the 10-year Treasury yield going back to March of 2020, but true across the pond as well with a 100 basis point move in just 2 days on the 2-year gilt yield between Friday and Monday. And of course, we saw it drop like a stone earlier today, down as much as 37 basis points. Now it's only down about 9 basis points. So it really speaks to the volatility we are seeing in the bond market, not just in recent days, but really on the year thus far. Just take a look at the move we have seen in 2022 for the 10-year Treasury yield. We are up more than 220 basis points. That is a record for any year, going all the way back through at least 1962, as the market has dramatically repriced the tightening expected from the Federal Reserve and central banks around the world. And that, of course, in turn has weighed on stocks, especially higher valuation ones that are more sensitive to higher borrowing costs. So collectively, when you combine the loss in market value of the Bloomberg Global Aggregate Bond Index and the MSCI World Index of Stocks, we have seen a drop of $29 trillion since the peak in November of last year. Absolutely brutal. across asset classes as the market braces for a potential global recession, which Ned Javis research now has about a 98% chance on. That extends to foreign exchange as well. We have seen the dollar strengthen to record highs and leave absolute carnage in its wake from Asia and Japan, where they had to intervene to stem some of the weakness of the yen. Of course, the pound in the UK dropping to a record low just yesterday at one point. So it's no surprise we've gotten a spike in FX volatility as well. The Deutsche Bank Currency Volatility Index of expected volatility in the Bloomberg Dollar Index rose 22% yesterday. That, again, is the most since March of 2020, John.
Not a shocker, given what we've seen in the bond market, that's for sure. Kelly, thank you. Evercore have some thoughts on this, just the disorderly nature of some of these moves. In their opinion, other people might disagree. Evercore said this, that Powell should take a page out of Lagarde's book. Here's the quote. We applaud the ECB's Lagarde for attempting to calm hawkish volatility without lurching dovish in testimony Monday. We think it is time the Fed leadership send a similar message that indicates awareness of macro and FCI spillovers and guards against overkill. Luke Hickmore, can I throw that at you? Is anything about what we've seen in the last week disorderly in your point of view?
I think actually probably not. Some of the liquidity is definitely hard to access in the gilt market, which, you know, is starting to get towards a disorderly market, but it's still doable. People are still executing. You know, we're clearing levels at higher yields, and the market's reacting pretty logically to what was an absolute shocking budget last Friday, and pushing fiscal when you're pulling in monetary just is really, really hard to achieve. So, no, I don't think this is disorderly. I think this is a sensible repricing. It's perhaps gone too far, and certainly at the front end it's gone too far, but not disorderly.
Look, that's the important point. A readjustment to attract capital into the UK market through a weaker pound and higher yields. A readjustment is different to a self-fulfilling negative downward spiral in either the currency or upward spiral in gilt yields. What I hear from you is that you think it's the former and not the latter.
Yeah, I think that's absolutely right. And, you know, a lot of currency crises, and this is what it's been, usually end up into a much improved balance of payment down the line. And it may take a year, 2, 3 years to get there. But this is going to help balance of payments problems that we've had in the UK for a long, long, long time, rebalance the economy, push up to more sensible levels of yield and borrowing rates we've had for the last 10 to 15 years.
We'll catch up with Guy Johnson on this in about 10 minutes' time. Looking forward to that conversation. Also need to get up to speed on what you're hearing from the South Side. JP Morgan's Marko Kolanovic speaking yesterday, writing this note, saying the following. Rising risk that Fed engineers a recession by intent or accident. Goes on to say, while we remain confident that a softening in labour markets and core inflation is in the pipeline, we're becoming less confident that central banks will pause. Now, I read that initially and thought, is Marko getting bearish? Marko's not getting bearish. This is what he had to say at the top on the equity market. Fed hawkishness leaves stocks very oversold. Some preconditions for a market bottom are falling into place. Stocks are looking increasingly cheap and approaching deep value outside of the US, and positioning is extremely depressed. Intriguing that the equity market boards are now talking about limited downside and not tons of upside, but we'll let that stay there for now. Julie, I want your opinion on this. This idea that some preconditions for a market bottom are falling into place. Did any of that resonate with you?
Yeah, I mean, we're starting to get there. At least now, you know, sentiment is starting to get very depressed, but valuations are also starting to look better and better. And so, you know, every day that we have really gloomy, emotional markets is the day that we're getting closer to a recovery. So I think it's positive. I think there's more realism. There's more understanding that a soft landing is just impossible to really navigate when you've let out this much fiscal and monetary policy. It's just not possible to engineer this with inflation this high. And so that realism is a positive thing. The thing is that, you know, we still kind of have a long way to go in terms of a possible correction. It's not like markets are cheap. They're cheaper. And I think that's an important distinction, and valuation is really important right now to be thoughtful about.
Judy, one thing that strikes me is that we've played this Fed pivot story maybe 4 or 5 times through the summer already, and then had to backtrack. The one thing that really, really bugs me, and I struggle with it, this idea that a Fed pause would be bullish. Now, it depends on what the economy looks like when we get that Fed pause. And I don't think an economic recession followed by a Fed pause is bullish. You're going to have, for the first time in a long time, a Fed that is not cutting interest rates in a recession. they may well just pause and watch the thing play out. Julie, do you think we're ready for that?
Yeah, I think that's exactly right. I think that's an important point, is that the reason for the pause is that the economics have deteriorated significantly enough. And they're nervous about moving forward either direction, right? Because we don't want a repeat of the 1970s. We don't want to keep doing this again. But there's going to be no dry powder to support the U.S. consumer or really anyone. So we just kind of have to let it play out naturally on its own, which we probably should have done more of anyway in the last 10, 20 years. I think going forward, markets tend to anticipate that. So once that really, really negative news starts to get played out, you could see equity markets do better, even if the economy is still struggling. That's typically how it plays out.
Luke, do you think we're ready for it?
I think we have been moving at an enormous pace, coming out of COVID, dealing with the Russian invasion, coming through this year and inflation shocks. The pace of the economic cycle is one that I think people are underestimating enormously. And it's quick, it's fast, and we could still see, and I realise I'm hanging on to threads, a pause from the Fed as we get into a recession quicker than everybody expects, and they have to react quicker than anybody expects. But, it's going to take us until the spring to really realise if that's the case.
Luke, stopping hiking, though, is different to starting to cut.
Yeah, it
you
is.
Understand
but you've
that
got to do one before you do the next.
Sure. You think the cuts follow pretty quickly?
I think they may do. If I'm right that this is an accelerated business cycle, then there's a chance we could see the Fed start cutting by end of the summer next year and into the autumn. But it's increasingly hard to hold that view with any level of conviction.
Luke Hickmore, Julie Biel, sticking with us. Futures still positive at more than 1% on the S&P. Coming up, the Fed, wait for this, the Fed warning about the spillover effects from abroad.
The key question will be, what does this mean for ultimately weakening the European economy, which is an important consideration for how the U.S. economy is going to perform?
That conversation up next.
What we've seen in the reaction to the proposed plan is a real concern and a fear that the new actions will add uncertainty to the economy. The key question will be, what does this mean for ultimately weakening the European economy, which is an important consideration for how the U.S. economy is going to perform. Trade with Europe is incredibly important for our economic performance, and if that gets weaker, that puts more stress on us.
It is slightly bizarre that the Federal Reserve is worried about weakness and policy abroad at a time that it seems to be fueling it with higher interest rates and a much stronger dominant US currency. For the Chancellor of the UK, the Chancellor now has his own headache in the FX market to own. It's pound sterling, which has been all over the place. We've gone from 103.50 through 109 and settled back down around 108. He met with insurance companies and asset managers in the City of London today to try and convince them about the fiscal package they delivered in the last week. Guy Johnson joins us now from London. Guy, good to catch up, buddy, as always. What did he have to say to them in the City today?
He talked about the fact that he is going to be announcing over the next few weeks some significant changes. He is going to focus on the insurance sector. He is going to sort out Solvency II. He's going to allow UK insurers to invest longer term into infrastructure projects. And he's talked about the fact that we are going to see supply side reforms coming through. In some ways, that was what was missing from last week's statement. We certainly need supply side reform here in the UK. How that comes, how quickly that comes, remains to be seen. There is a slightly more sort of calm sense now prevailing in London, John, today. I think the market is settling down a little bit. I think there's an appreciation that we saw this situation evolving at a time of an incredibly strong dollar, and I think that needs to be borne in mind. But it's a really difficult situation for the UK to manage, not only from the fiscal side, but also from the monetary side. Governor Bailey's slightly terse statement yesterday, probably, I think, now leading to an expectation that we don't see anything before November.
Guy, can we talk about that statement? Here's a quote from it. The bank is monitoring developments in financial markets very closely in light of the significant repricing of financial assets. What did that statement mean, Guy?
wait and see. I think it just basically meant we're not going to do anything. I think there's a sense of frustration at the bank as to what is happening here. I think a lot of people have been caught on the hop as to just how big the market reaction has been. But the bank now faces a significant problem. The market has priced in much tighter policy. How does the bank now react? Does it deliver that tight policy? Are we going to have to wait until November for that tighter policy to be delivered? It is a significant step up that the Bank of England is going to have to deliver, plus 100 basis points or more could be required. It'll be interesting to see how the market reacts when that comes. Does this settle the situation down? But, John, the UK is already dealing with tighter monetary policy. You look at what is happening in the mortgage market right now. Yeah. You look at what is being priced there. You look at the 3-year swap. The 3-year swap, interest rate swap, is now at 5%. Started the year at 1%. That's how you price mortgages in the UK. Anybody coming off a 2-year rate, anybody coming off a 5-year rate is going to be hit with that straight away.
Guy, you're just not offering new mortgages right now, are you? You're just waiting for this to settle down. Isn't that what we've basically seen from some of the banks in the last day or so?
Yeah, it'll take them a few days just to figure out what exactly they want to do. But it is a step change, John, in terms of the pricing that we're looking at here. A lot of people are going to be coming off 2-year fixes over the next year, and they're going to be facing a huge, huge step up. How do you reprice the UK housing market in that kind of scenario? We've been used to very low rates. They don't exist anymore.
Big struggle. Guy, looking forward to the coverage, the show, in about 42 minutes' time with Alex Steele. Deutsche Bank and George Saravelos wrote about this a little bit earlier today, and one question we've been asking repeatedly over the last couple of weeks, in fact, over the last month, whether what we're seeing play out or what we're about to see play out is a readjustment, just a normal readjustment. We talked with Luke Hickmore about it, of higher yields, a weaker currency to attract capital to finance the deficit, or something like a self-fulfilling negative downward spiral. George Saravelos framed it as follows. Crucial question, his words. What is the clearing level of UK asset prices and gilt specifically? He went on to say, at which investors would be willing to fund the UK. The market is itself already attempting to answer a record low in the exchange rate, a near 2% rate hike by early November, and a 6% terminal rate from the Bank of England. If this is not delivered, it risks further currency weakening, further imported inflation, and further tightening. That's the vicious cycle that comes off the back of it. Luke Hickmore, I want to throw this at you. What would happen if the Bank of England does not validate current market pricing at its next meeting in early November?
It wouldn't be good. I think the currency would be well below 1. 30-year gilts would be banging into a 4.5, 4.75 area very quickly. And we're looking at a lot of pain. But I suspect we're also not going to get validated at a 6% terminal rate. I think the UK economy can probably live with a late 4, maybe early 5, but it really can't live with a 6% plus terminal rate. I mean, you were saying about mortgages, 300,000 people a month are coming off a fixed rate mortgage.
This is going to be really, really painful stuff for the United Kingdom. Judy, Bill, you and I have spent a lot of time through the summer talking about how to hide from some of the economic weakness. How do you hide from what's happening in the FX market and the weakness that's developing abroad, not just in the UK? I'm thinking of Europe much more so, thinking of China as well.
Yeah, I mean, I think it's a pretty difficult, as much as it's a difficult economy in the US, when I look abroad, I'm pretty pleased that I'm a small and mid-cap investor in the US. So, you know, I continue to focus on businesses that don't have a lot of that FX exposure, because that hits in a variety of ways, right? It's not just that the currency that you're bringing back is worth less, right? Your goods or services are less competitive. Your cash flow is less positive. It has multiple impacts, and it actually could have long-term fundamental reflections as well. So for me, you know, focusing on high quality small and mid caps has actually been pretty positive, especially in the last week or so.
Julie, what is high quality small and mid cap? What do those companies look like? What do they do?
You know, they're businesses that typically have a nice niche that's well protected. You know, they typically don't raise the ire of regulators the way that a Facebook or Google do, because they are able to own their own destiny within their own markets. You know, small and mid-cap tech that's vertically focused is wonderful. You know, there are some medical companies, healthcare companies that, you know, may manufacture a small little widget, right? But they own that market. They're very profitable. I think it's really important to own businesses that have done well in the last cycle. Jack Henry, for example, They serve financial institutions. You can't tell that it went through a financial crisis if you look at its numbers. That's the type of business we want.
Is that how you're backtesting them, Julie? You look back to that kind of period to see how they performed?
Yeah, absolutely, right? It feels very crude, right? Because there's a lot more going on right now. But honestly, it's probably the best metric I can gauge. And let's say I own businesses that, didn't exist in that time period. They better have either a lot of recurring revenue that's profitable, not just regular recurring revenue, but it needs to also be something that's pretty mission critical, something that you're not just going to switch off the way that you're going to switch off your Netflix and your Hulu because you lost your job. Those are the types of businesses that I want, durable ones.
Luke Hickmore, I want to give you the final word, and it's on the global credit story. I've heard this a lot, that we're not going to get a massive default cycle, that we had all the stimulus after COVID, that the leverage isn't there in the way that it was anymore. Luke, has your mind changed somewhat as this year has progressed on that theme?
I'd like to say no, I really, really would. But it's changed in the last few days because I think what the broad yield market starts to price in is a much, much deeper recession than we've been expecting for 2023 and possibly bleeding into 2024. And if we get that, then I think we get ratings drift, where we get a large downgrade cycle. Whether that leads bad enough into a larger default cycle, I think remains to be seen. But we're already seeing the new issue market for high yield has shut down over the last week. And if that continues for any length of time, we could see some stress coming in. So I'd say it's mildly moved towards more concern, but definitely not in the camp of it's all going to be really, really horrible next year.
I have a feeling we'll be talking again before that next Bank of England decision. Luke Hickmore there. Thank you, sir, alongside Julie Beale. Brilliant as always. Here's another one. Santander temporarily pulling some UK mortgage products, according to Reuters this morning. Unsurprising given what we've seen in the last day or so. Up next, your morning calls, and later, a conversation you do not want to miss. It's Mike Wilson and Morgan Stanley at the opening bell. Stocks bounce. Here are your morning calls. First up, Citigroup cutting McDonald's to 246, opening a negative catalyst watch on shares due to its outsized European exposure. Evercore upgrading Hyatt Hotels $100 price target, expecting the company to benefit from easing travel restrictions. And finally, Goldman downgrading Keurig Dr Pepper, seeing a more balanced risk reward with consumers facing inflationary pressures. That stock is down by almost 2%. Coming up, Morgan Stanley's Mike Wilson saying stocks have yet to find a bottom. That conversation coming up next. Your opening bell just around the corner. Five-day losing streak on the S&P 500. Here's the bounce. We took out the June low, the closing low on the S&P. We bounced back by 1% on S&P 500 futures. On the Nasdaq, up by 1.4. On the Russell, the small caps, positive by 1.26%. The opening bell in New York rings. Switch on the board and get to the bond market. Equities at new lows for 2022. At yesterday's close, the 10-year at new highs. Highs we have not seen since 2010 on a 10-year. We come back down lower, negative 3 basis points. That move fades, though, a fair chunk from where we were about an hour ago, 389.21. The euro just about showing some strength here. Will that stick? Euro dollar positive 0.1%, 96.21, and crude up by 1.5%, 77.85. About 20 seconds into the open, let's get you some movers. Here's Abby.
John, well, we do have a bit of a reprieve here for stocks for sure. We're looking at the best day for the S&P 500 at this early moment in about 2 weeks. This, of course, as you were just mentioning and outlining, yields coming in. That's giving stocks, especially tech stocks, a bit of a reprieve. Apple up 1.3%, valuation a bit less of a concern. Oracle up 0.9%. We did have some breaking news on this stock not so long ago that they are, the company, I should say, they're agreeing to pay $23 million to settle foreign corrupt practice charges. Not the first time, not a huge amount of money. In fact, a very small amount of money for them. But that stock off of its highs, nonetheless, still higher, up 0.9%. Coinbase, the cryptocurrency exchange, it is rallying in a big way, up 4.8%. This, of course, as we have Bitcoin and Ether and some other of the crypto really up in a big way. And then finally, we have that bid for oil that you were just showing, John. That means big energy is up, including Exxon, Chevron, but we also have some of the E&P names, such as Devon Energy, up 1.6%. In fact, energy, the third best sector, most sectors, all sectors right now, higher, so it's a broad-based rally.
Energy up by 1.28%. Abby, thank you. The equity market, the S&P up by 1 full percentage point. Will this bounce stick? Because the bid in the bond market is fading just a little bit. The 10 years now lower by just 3 basis points. The 30-year higher by 2 basis points. The long end of the UK, the gilt market, that yield is surging once again. The S&P, as I say, up by 1.1%. On the S&P 500, information technology there up by 1.65%. So we've got a big tech bounce, for now at least, looking to avoid the longest losing streak since February 2021. Ed's back with us for more. Hey, Ed.
Yeah, morning, John. We're up 1.6% on the Nasdaq 100, snapping 5 straight days of losses, which was the worst run since February of this year. But it started on Monday, right? We saw mega caps make gains in yesterday's sessions with some of the more speculative corners of the technology sector not really following suit. We are pushing higher names like Nvidia. Amazon has seen gains in recent sessions, also seeing some of the EV makers climb higher as well. Nasdaq 100, of course, coming off its lowest level since June of this year. The S&P 500, if you just take recent performance, there is some outperformance on the Nasdaq. And some of those downtrodden names that were really hurt by yields. For me, this is a yield story, right? The chart says it all, that as we saw that push higher in real yield, the Nasdaq 100 suffer. Lo and behold, a pull back in yields, and woo, off the Nasdaq 100 goes, and we're all a little bit happier this Tuesday morning.
Let's see if it sticks, and that's Smart Stays this afternoon when you do the tech show. Ed, looking forward to that, sir. Thank you. Just getting some comments from Hugh Pill, the chief economist from the Bank of England, just responding to some of the price action we've seen. The MPC cannot be indifferent to market repricing, is something he said. He also says the Bank of England has responsibility for keeping orderly markets, monitoring developments in markets very closely. Just that line that central bankers like to throw around. Clearly a UK-specific element to the significant repricing of assets that we've seen. The comments from the chief economist of the Bank of England just there. Sterling still positive on the day, but fades a little bit. It's positive 0.7% at 107.60. Guy Johnson's going to run back to the microphone in just a moment. We'll catch up with him on this story soon. I want to turn to Taylor Riggs now. Taylor, FedEx, GE, Ford, warning after warning. Is that going to dominate earnings season in the weeks to come?
Let's talk about that. Earnings season really set the stage heading into this. It has been what has been almost a record-breaking end of an era, John. If you thought about coming into today, 13 straight days of yields rising on the 2-year yield. That reverses. So we'll say goodbye to at least to that record-breaking streak and see a boost a little bit here to equity markets that you see on the screen. Finally, the equity markets catch a break as yields on the front end start to roll over just a little bit. Coming into this, it's also been historic when you think about 10 or 11-day losses in the S&P 500 and big 10 or 11% declines in that period. Typically, though, with you get these big 10% drops in this short amount of time, on a 1, 3, 6 month average time period, stocks always end up, majority of the time, a little bit higher. Except that then you take a look at this screen, John, and this sets us up when you think about the earnings outlook going forward. There have been some revisions downward, of course, relative to upgrades. And this is the volatility that hits the this quarterly earnings season coming up. But also, is this also sort of a bottoming out? Is this exactly what the market wants to see? A reevaluation of this earnings season.
October 14th, just around the corner, JP Morgan unofficially kicking things off in a couple of weeks' time. 2 weeks on Friday, I believe. Taylor, thank you. Hugh Pill of the Bank of England making some headlines. The market moves, a challenge to the inflation goal. Guy Johnson back with us in London for more on this. Guy, finally getting some comment from the chief economist. Your take on this?
I don't think it's antagonistic to what we got in the statement from the governor yesterday. I think there is some nuance in here, though, John, that is important. The market moves a challenge to the inflation goal. The lower sterling rate that we are now experiencing clearly will have an inflationary impact. What is interesting, though, is that the market has effectively done the Bank of England's job for it, so it is already tightening policy. So it'd be interesting to know kind of what offsetting forces are at work here. The vehicle for assessment of markets is the MPC forecast. They rely on the markets for their forecasts, so the forecasts are going to change really quite significantly. That, in some ways, has always been a little bit of a bug in terms of their forecasting and what they do. They take what the market is saying. Fiscal measures will act as a demand stimulus. Again, this is this kind of comment around whether or not monetary and fiscal policy are going to be antagonistic. So basically, he's saying, on one hand, you are going to see these fiscal measures potentially being inflationary. You could argue that also you are going to see that with the sterling story, which is going to be potentially having an impact there as well through the energy channel and other channels as well. Therefore, the market cannot be the MPC cannot be indifferent to market pricing. Fiscal measures will act as a demand stimulus. Basically, you've got monetary policy and fiscal policy, John, potentially pulling in different directions here. How big the bank needs to go in reaction to that, I think, is the open question here.
And whether they can wait until November 3rd when they meet next.
Yep.
Guy, looking forward to your coverage, as I say, mate, in about 22 minutes' time, 24 minutes' time to pick up on this. November 3rd is the next Bank of England rate decision. So it looks like more hikes from the Bank of England, from the ECB, and again the Federal Reserve. And back in the US, Goldman cutting equities to underweight. BlackRock telling investors to shun most stocks. Pretty much everyone now. I say almost everyone, I should say. Bearish. A growing list of firms turning more bearish with recession fears casting a big shadow over Wall Street. Kaylee with us for more. Hey, Kaylee.
Hey, John. Yeah, no more bears in hibernation. They are awake and they are growling. Goldman Sachs saying right now valuations don't reflect the risks that are out there, including the increasing probability of a recession, which they now say is greater than 40% odds. BlackRock also saying a recession is not yet priced in, that they do not see a soft landing, which means more pressure on risk assets, similar to concerns voiced by Morgan Stanley and JP Morgan Asset Management. Really, the key takeaway is that this idea that while things have been bad, they're still going to get worse. And just for a reminder of how bad it has been thus far, the MSCI World Index of Stocks is down around 25% on the year. That is equivalent to about $24 trillion in lost market capitalization. And just about a third of that has come in the last 2 weeks. From mid-September to now, it has been extremely brutal. Now, part of that can be blamed on the dramatic rise in rates, especially real yields here in the U.S., which are now north of 150 basis points. But there is the dollar factor to consider as well. This was the research out of Morgan Stanley, Mike Wilson and the team putting this out yesterday, essentially saying that the dollar can spell bad things for risk assets, considering when you look back at history at moves in the dollar we have seen that are similar. The dot-com crisis, financial crisis, sovereign debt crisis, all in the last 20 years or so. You saw dollar moves like the one we are seeing now. So that doesn't spell great things for stocks, John.
Kelly, thank you. You mentioned Mike Wilson. If the year ended now, Mike Wilson of Morgan Stanley would be the equity market strategist of the year on Wall Street. Morgan Stanley's Mike Wilson writes the following: the recent moves in the US dollar create an untenable situation for risk assets that historically has ended in a financial or economic crisis, or both. Mike, I'm pleased to say, joined us right now. Mike, always fantastic to catch up with you, sir. There was a graphic that went with that quote, and I put that out on Twitter. It was Exhibit 3. It was the US dollar year-over-year change. And you guys pointed out that it's at a level that usually leads to financial and economic stress. And there's all these different peaks in that chart over the last few decades, Mike. And on each peak, there is a crisis, as you point out, but it's usually been met with Fed easing. Mike, is it going to be met with Fed easing this time around?
Well, thanks, John. It's always great to be with you. I probably should have used my PR agent. I would say, look, I mean, that chart is provocative. I mean, you know, that's what we do. But it's also informative. And I think there's three takeaways. Number one, the dollar is at a point now where it's causing real stress in the real economy, mostly outside the U.S. That's the way it usually works, right? The transmission mechanism is that, you know, as John Connolly said, former Treasury Secretary back in the 70s, it's our currency, it's your problem. And that's exactly what's happening. You know, EM has been terrible. Some of the other regions have had stress because of the stronger dollar, in addition to higher commodity prices, which is a double whammy. So that's, you know, one transmission channel. Number two, once it gets to this level, it doesn't stay there very long. You can see in that chart, it's almost a spike top every time. And then the third point, which is kind of interesting, those spikes are sometimes met with a low in equities and sometimes met with a high, like that's the beginning of the real decline. Given that we've been declining already this year, you know, it could be a little bit of both. I think we're into the final stages of this bear market. We've talked about this, I think, last week on your show. But that last stage, you know, can be fraught with a lot of risk for investors. And, you know, as you know, John, we're pretty disciplined around our framework, and we just don't see the fat pitch yet, specifically as it relates to S&P 500 equity risk premium. What I mean by that is, while rates have been priced into multiples, what's not been priced into multiples now is the earnings risk, which we're focused on. That can come in two ways. Either the earnings get cut or the equity risk premium blows out and the multiple goes down lower first. Now, as you guys have been saying on the show the last 10 minutes, I've been listening, I think you've got this right in the sense that, whatever rates do in the short term can dictate equity prices in the short term as well. And so if we get a rally in the back end, which looks like it should happen from here, then, stocks could get a little lift here into earnings season. It's kind of the opposite of the June quarter, where stocks sold off into the quarter and then rallied on kind of, better than feared news. This time it might be the opposite. We may rally into the earnings season, and then the news is actually worse than feared because companies finally start talking about, the risk from currency, the risk next year from a recession, and all those things kind of get priced quickly.
Well, we're going to get more rate hikes, that's for sure, including from the Bank of England. The chief economist speaking right now, Hugh Pill, saying that the fiscal news requires a significant policy response. That tees up a significant rate hike at their next meeting, their next scheduled meeting, November 3rd, if they wait that long. Mike, one thing you pointed out there was the growth story. I know the pushback, because you referenced the pushback in your recent research. The pushback is, how on earth can we get negative nominal earnings growth when we've still got high inflation? Mike, what do you say back?
Yeah, so we discussed this last week as well. This is the pushback we've gotten for the last 4 or 5 months. That that we live in a nominal world. Obviously, inflation is a big part of that, and so when you have nominal GDP that's still significantly positive, even if you have real GDP that's negative, which is the definition of a recession, you can still get positive earnings growth. And I agree with that in concept. Here's the problem with that rationale. Higher inflationary environments, one thing we know is that it leads to higher operating leverage. Okay, so when you have positive operating leverage, like coming out of the pandemic when they were stimulating, that leads to incredibly strong earnings growth. In other words, inflation inflates profits. The problem now, John, is that costs are increasing faster than end price point. And what that means is you're now into a negative operating leverage part of the cycle, and inflation will amplify that to the downside. And I think that's the one area we may be actually not bearish enough, quite frankly, which is that the negative operating leverage that we're about to experience, if our earnings model is correct, then our forecast may not be bearish enough on the earnings side. We'll have to wait and see how that plays out. We don't really have to go there yet because we're so far below the street, even on our base case on the earnings side, that we'll be able to adjust that lower. But that's one thing that we're watching carefully this earnings season.
So, Mike, just in terms of industry groups on the S&P 500, which industry group, which company, which set of companies is more vulnerable to that story you just told?
Well, you got to start very simply. You just say, let's just look at where the over-earning was the greatest, right? And that would be a lot of the consumer discretionary area, the consumer goods, where there was clear over-earning because there's no discounting going on. I think the technology sector is another vulnerable place because they also over-earned, and now their costs are a little bit out of control. There's more competition there too now because that's where a lot of malinvestment happened because everybody put their money into new companies in tech. Maybe industrials, some of the commodity areas. I mean, we've noticed that a lot of these stocks are trading extremely cheaply, 2, 3, 4 times earnings. And the old adage, as you know, John, is you never want to buy a value stock or a cyclical stock when the multiple is low, because it's telling you that the earnings are about to get smoked. So I think those are the areas, anything that's really economically sensitive, and of course, those areas where you over-earn the most.
Equities right now positive 1.5% on the S&P, on the NASDAQ up by close to 2%. I want to talk about this positive correlation, Mike, between equities and bonds, something you've talked about in the past and we should discuss now. When's that going to break, Mike? What's going to lead to a break in that positive correlation?
A recession, probably. That's usually the way it works. So far, treasuries have not acted as a safe haven because of the central bank's, dilemma to have to tighten into this slowdown. Normally, by now, the Fed would have paused. They probably, I don't know if they'd be cutting, maybe they would have paused, and that would have led to a sharp treasury bond rally as stocks potentially went down. Okay. So, that's probably the way this is going to end in our view. As we get later in the year or early next year, the Fed will pause. Eventually, they will pivot. We don't think it's right now, clearly, but they will pivot, and they will pivot because something has broken, or we're in a recession, or both. And that's kind of where we're driving towards that. The Fed could not be more explicit. That was the title of our note this week. They are being crystal clear that they are driving us into what they call, and I use their words, pain. Okay, so I wouldn't fight that. Don't fight the Fed. It's a pretty good adage to pay attention to.
Hearing that from Bullard right now, the credibility of an inflation targeting regime, their inflation targeting regime, is at risk. The willingness to do more. Mike, at the start of the year, as the year progressed, you were the outlier. Now everyone's doing an impression of Mike Wilson. Mike, everyone's long cash. They're all bearish. I can pick out a few bulls, the likes of JP Morgan and some others. Mike, when do you start to lean the other way? Is consensus enough for you to get uncomfortable, or is it something else?
Well, I mean, it is getting a little crowded, and bearishness is, pretty popular now. And that is one part of the conditions we look for. But it's not the only condition. One of the reasons we didn't turn bullish in June, even though the sentiment and positioning was as bad as we've ever seen, the breadth was there too, was that the fundamental backdrop did not support it. And what I mean by that is, we're staring down the barrel of what we think is coming now, which is that the earnings are going to disappoint. And as I mentioned earlier, I mean, the equity risk premium never priced that. So we got to get the price right, or we have to get earnings lower in conjunction with this, pervasive bearishness. Now that may mean, John, that we don't have to go down and hit those lower targets that I've talked about. Like we could just kind of trade around these levels. But when we think about risk reward, okay, we need upside to get excited. And so I think a lot of people, they say, oh, it's a low, I got to buy this. Say, well, what are you buying? Where are we going to trade to? If we're still cutting numbers, there's not a lot of upside. So you have to balance that. We think the risk reward here, even at 3,700, is better than it was at 4,000, obviously, but still not that attractive. It's probably 3-to-1 to the downside.
Mike, I wanted to fit this in. Just a final question, and forgive me for the crystal ball type stuff. It's something for the future, a long time horizon perhaps. Are you and the team giving thought to the future of things like passive investing, given the high weighting of growth stocks on the S&P that have benefited from a decade of zero interest rates and a ton of QE? The reason I ask this, Mike, is more recently I keep speaking to investors about whether we could see a lost decade for passive investors hugging the benchmark, the index, the S&P 500, waiting for a return to the old regime that just never comes around. Mike, are you having that conversation? What does it sound like?
Well, we've left Kansas, Toto, in that regard. I mean, I would say there's no doubt there was a regime shift, that was driven by this breakout in inflation. And, we've been looking to get inflation for 20 years. Of course, it's like the old ketchup bottle routine. You squeeze the bottle and then you get too much. And that's where we are now. And we're not putting that genie back in the bottle. So we're very much in the camp, as you know, that we're entering a period of fiscal policy dominance, no longer monetary policy dominance. Monetary policy can no longer be as accommodative as it has been historically because inflation is here to stay, but it's going to be volatile. And so the way we think about it, John, is I agree with the concept that perhaps, particularly in real terms, okay, inflation adjusted, stocks are going to have a hard time generating that much return in real terms over the next decade. However, there's going to be incredibly profitable periods to trade it, which is what we do. I mean, we are cycle analysts. Okay, that is our entire framework is based on that. We have a lot of confidence in it. We call it the boom bust. We think we're entering that. And so you can expect that we're going to get pretty bullish at some point when we feel like that next boom is within sight. And when I say within sight, it doesn't mean tomorrow. It can be 6 months out. It could be 12 months out. And that the bust has been priced. So that's how we're thinking about it. We try to be tactical, and we have a framework, and obviously we can be wrong about that, but that's generally our view. It's a boom bust environment probably for the next 5-10 years. Inflation will oscillate back and forth. The Fed will deal with that, and the big lever is going to be fiscal. We're already seeing that, right, John? We're seeing it in the UK with the increase that we're seeing it in the US. We just did two fiscal stimuli, right? We saw the IRA, and then, of course, we have the student debt forgiveness. Those are big programs in the face of, we're trying to calm inflation down. So I think we just got to get used to that. It's going to be a much more volatile economic outcomes, which means equity risk premium should be higher, not lower. And it's going to be probably a higher earnings growth period from point to point, but with a lot of volatility in between.
Well, the year's not over yet. We've still got 3 months and change to go. Mike Wilson, thank you, sir, of Morgan Stanley. Appreciate it, buddy, as always. Your equity market right now on the S&P up by a little more than 1% on the S&P 500. Tons of hawkish speak in the last 10 minutes or so. From the Bank of England and the chief economist, Hugh Pill, the fiscal news requires a significant policy response, to Jim Bullard of the St. Louis Fed, who said the credibility of inflation targeting in their regime is at risk. What more do you want? From New York, this is Bloomberg.
The
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Jason Furman, Foreman Council of Economic Advisors Chairman. That conversation at 12 p.m. Eastern, 5 p.m. in London. This is Bloomberg.
I don't think they've been realistic about the pain that they're actually going to cause. If you look at their forecast last week, the unemployment rate climbs a little bit. It climbs up to 4.4%, and then inflation melts away. I don't think it's going to be quite so simple as that.
That was the former New York Fed president, Mr. Bill Dudley there, weighing in on Bloomberg surveillance a little bit earlier. We're going to get a ton of Fed speak this week and a sprinkle of economic data. Taylor Riggs has more. Hey, Taylor.
John, and you're right with that big Bloomberg opinion column coming out saying that really the Fed is sort of underplaying or underestimating the pain that's really going to be coming when you think about this inflation targeting regime and then what happens on the economic side as well for that. So can we continue to out-hawk ourselves and we get all of this Fed speak coming up? You also did hear from Charlie Evans, of course, overnight as well, saying that 4.5% unemployment would be okay. That would be a good outcome. So again, a focus on inflation and a focus here on the world of economics. Take a look at real yields. We spoke with Subhadra Rajappa at SocGen, of course, yesterday, John, highlighting the rate of change in nominal yields, but the rate of change in real yields as we've really come off the depths of the lows of negative real yields. And as you can see, they're firmly into positive real yield territory, the tightening of the financial conditions that this chart represents. Finally, if you just want to think about the death of the 60-40 portfolio year to date, the worst we've had since 2008, it is all dollar strength. It's bond lower, equities lower as well, but cash and dollars good.
Brutal, brutal. And everyone seems to love dollar cash right now. Taylor, thank you. Just absolutely awesome. As always, Taylor Riggs. Looking forward to the close a little bit later. We're repricing the Bank of England once again. Hugh Pill, the chief economist of the Bank of England. The fiscal news requires a significant policy response. Guy Johnson and the team, they're going to pick up on that story in just a moment. Jim Bullard doing what Bullard does. He's sounding hawkish, saying the credibility of our inflation targeting regime is at risk. From New York City, thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.